Jaguar enters the period leading into 2026 in a state of strategic and financial tension that can no longer be explained away as temporary disruption or transitional noise. The brand is attempting one of the most radical reinventions in modern automotive history while its underlying economics remain deeply fragile. Jaguar is not simply navigating a difficult market cycle. It is attempting to rebuild its identity, product portfolio, and customer base at the exact moment its cash tolerance and operational resilience are at their weakest. The core problem is that Jaguar has been shrinking for years before the reinvention even began. Global unit volumes have declined steadily as legacy sedans lost relevance and crossovers failed to achieve sufficient scale. This contraction hollowed out revenue, while fixed costs remained stubbornly high. Manufacturing facilities, engineering teams, and global distribution networks were built for greater throughput than Jaguar currently commands. As volumes fell, per unit costs surged, compressing margins and pushing the brand into persistent operating losses. Rather than stabilizing the business around profitable niches, management elected to pursue a full transformation into an all-electric, ultra-luxury brand. Strategically, this may sound bold. Financially, it is perilous. Reinvention at this scale requires enormous upfront capital before any meaningful return is possible. Entire model lines have been discontinued, leaving gaps in showroom traffic. Future electric models remain largely aspirational concepts rather than revenue-generating products. During this long transition window, cash continues to flow out while little flows in. Debt and funding pressure loom large. Jaguar does not operate as a standalone entity, but its performance directly burdens its parent structure. Heavy investment in new platforms, battery technology, software systems, and bespoke design language must be financed long before sales materialize. These investments are not optional. Without them, the reinvention narrative collapses. With them, the cash burn accelerates. This creates a narrowing corridor where execution must be flawless, or financial stress escalates rapidly. Electric vehicle economics worsen the risk. Ultra-luxury electric vehicles demand low-volume craftsmanship combined with extremely high technology content. Batteries remain expensive. Software development costs continue to rise. Regulatory compliance adds further burden. At the scale Jaguar is likely to achieve, cost absorption will be limited. Unlike mass-market electric producers, Jaguar cannot rely on volume to dilute investment. Unlike established ultra-luxury brands, it lacks the pricing power and order backlog to offset risk. Brand erosion compounds the challenge. Years of inconsistent product strategy and declining reliability perception have weakened consumer trust. Jaguar once benefited from emotional appeal and heritage. That appeal faded as products aged and competitors surged ahead in technology and perceived quality. Asking consumers to wait years for an all-electric identity requires faith that many buyers no longer possess. Lost loyalty is expensive to rebuild, and marketing spend alone cannot substitute for sustained product credibility. Dealer networks are under strain. Reduced product variety and low inventory throughput pressure retailer profitability. Dealers are being asked to invest in new electric infrastructure and luxury experience upgrades without near-term volume assurance. Some markets have already seen consolidation or quiet exits. A thinning dealer network undermines customer confidence and increases service friction. Luxury buyers expect immediacy and convenience. Any compromise damages the brand. Promise. Operational decay is visible behind the scenes. Long product gaps reduce engineering momentum and morale. Suppliers face uncertainty about future volumes and specifications, and that makes them less willing to commit favorable terms. When suppliers prioritize stronger customers, costs rise and delivery risk increases. These pressures rarely appear in headline announcements, but they accumulate relentlessly within the cost structure. Liquidity risk cannot be ignored. Cash outflows tied to restructuring, plant reconfiguration, and workforce realignment continue alongside investment spending. Asset sales and internal funding can bridge gaps temporarily, but they are not sustainable sources of long-term viability. Each year of negative free cash flow increases strategic dependency and reduces optionality. At some point, the question shifts from how to reinvent to whether the brand justifies continued capital allocation at all. The timing is particularly unforgiving. Global luxury demand is becoming more volatile. Interest rates remain elevated. Electric vehicle pricing pressure is intensifying as competition increases. Jaguar is attempting to leap into a narrower and more competitive segment, precisely as consumer tolerance for risk declines. This is not an environment that forgives delays or missteps. The reinvention narrative assumes that scarcity and exclusivity will drive margins. That assumption remains unproven. Scarcity without demand is not luxury, it is contraction. Until confirmed orders and sustained pricing power emerge, Jaguar remains a brand burning cash in pursuit of an identity that exists mostly on presentation slides rather than balance sheets. Please subscribe to our channel. We want to hit 1,000 subscribers this week. For consumers, Jaguar's current trajectory introduces a risk that goes beyond styling or performance preferences. Purchasing a vehicle is a multi-year financial and practical commitment. That commitment depends on the manufacturer's ability to support products consistently through service networks, parts availability, software updates, and residual value stability. Each of these areas becomes more uncertain when a brand undergoes prolonged structural stress. Warranty coverage often appears reassuring on paper, but the ownership experience depends on execution. Brands under cost pressure tend to tighten approval processes and reduce discretionary goodwill over time. What begins as generous support can gradually become more transactional. Consumers may encounter longer wait times, stricter interpretations, or limited flexibility when issues arise beyond basic coverage terms. Parts availability poses another concern. Jaguar vehicles rely on a mix of shared and unique components. As volumes decline and model lines shrink, economies of scale weaken. Suppliers may produce parts in smaller batches or prioritize higher volume clients. This can lead to extended repair timelines and higher costs, particularly as vehicles age. For luxury buyers accustomed to seamless service, these disruptions carry outsized dissatisfaction. Software and digital support are increasingly central to vehicle functionality. Electric and semi-autonomous systems require continuous updates to maintain performance and safety. A brand allocating most of its resources toward future products may slow investment in existing platforms. Over time, this can leave current owners with vehicles that feel technologically stagnant. The resale market reacts quickly to such signals. Depreciation risk is significant. Market confidence influences residual values as much as product quality. If buyers perceive Jaguar as unstable or transitional, resale prices will reflect that uncertainty. Higher depreciation effectively raises the cost of ownership regardless of initial purchase incentives. Leasing becomes more expensive or requires manufacturer subsidies that may not persist indefinitely. Dealer stability affects everyday ownership. Reduced dealer density increases travel distance and service wait times. Remaining dealers may be stretched thin or reluctant to invest further. Luxury ownership loses its appeal when convenience erodes. In secondary markets, the risk of diminished support is particularly acute. There is also the risk of strategic reversal. If the reinvention fails to generate sufficient demand, Jaguar may be forced to adjust timelines, delay launches, or quietly scale back ambitions. Such shifts create uncertainty for owners who expected long-term continuity. Even without outright failure, prolonged ambiguity undermines confidence. None of this suggests that current Jaguar vehicles are unusable or unsafe. Many offer compelling design and driving character. The issue is the durability of the ecosystem that supports them. Luxury ownership is about confidence as much as craftsmanship. When a brand is burning cash while betting its future on unproven demand, that confidence is fragile. From a forensic financial standpoint, Jaguar represents a high-risk transformation story with a limited margin for error. Consumers considering the brand should do so with clear awareness of the broader context. Emotional appeal and design ambition do not offset structural cash burn and execution risk. Prudence favors caution when the gap between aspiration and financial reality continues to widen. Please subscribe to our channel. We want to hit 1,000 subscribers this week.